Very good afternoon, everybody, and a very warm welcome to all of you, ladies and gentlemen. On behalf of the Federation of IT Industry Sri Lanka, let me welcome you to today's very apt and important webinar on international tax trends due to digitalization of economies, a discussion on new taxing trends through digital service tax and the inclusive framework on BEPS. My name is Abbas Kamruddin. I'm the immediate past chairman of FITIS. And I would like to mention that this event today is brought to you by Federation of IT Industry Sri Lanka, which is the representative of the ICT industry in Sri Lanka, which includes all the different elements of the ICT industry, including the hardware chapter, the software chapter, the education chapter, the training chapter, the communication chapter, and of course the most importantly, the chapter that is currently bringing this to you, which is the digital platforms and services chapter. So I would also like to take this opportunity to thank our partners for this program, our platform partner /Tech Labs, our messaging partner TechSphere, our print media partner Daily FT, our knowledge partner EY, and our premier partner .lk, as well as our corporate sponsors, .lk, Abans, Asiata Digital Labs, Connex Information Technologies, DMS, Dialog, Epic, Huawei, Just in Time, Lankabel, Luna Labs, Oral IT, Sarva, SLTC, SoftLogic, and Zillion. Thank you very much to all our partners for supporting us and making this event possible. With that, I would like to warmly welcome or bring to your attention the speakers that we have today. We have with us Sing Yi Wong, who's a partner at Ernst & Young EY Solutions LLP, as well as we have as our moderator today Sulaiman Nistar, a partner at Ernst & Young. Let me first of all let us start the session today with introducing the partner from EY, Sing Yi Wong, to share with us her expert knowledge and in-depth understanding on this subject. And I'm sure we'll have a lot to grasp from this, and we can get a good understanding of where the world stands today with regards to digitalization of economies and related tracks. So with that, thank you very much, and over to you, Wong.
Thank you, Abbas, for the kind introduction. Good afternoon, everybody. My name is Sin Yi. I'm a partner with Ernst & Young Singapore, and I'm very honored to be invited today to share on the international tax trends relating to digitization of economies. So just give me a second to share the screen. All right, I hope everybody can see my screen. So once again, for the next 30 to 40 minutes, I'll be giving an overview of what is BEPS 2.0. So BEPS standing for Base Erosion Profit Shifting, a project initiated by the OECD, and how it's impacting on digital services taxes as well as businesses. So the agenda really will cover what's the purpose and the timeline for the BEPS 2.0 project, which you may have read in the papers as well. I think this is a global hot topic right now. I'll give an overview of the two-pillar solution, which is being introduced under BEPS 2.0. Then we'll do a recap of what is digital services taxes, and then the BEPS 2.0 impact on digital services taxes, as well as businesses, to wrap up. So firstly, let's start off with the purpose of BEPS 2.0 and the timeline. So really, the Base Erosion Profit Shifting project was initiated by the OECD back sometime in 2013. And the impetus for this project is really because they felt that a lot of the tax revenue has been decreasing, and the existing tax laws are not well equipped to tax how the businesses are now conducting business. With digitalization, with the advancement of technology, a lot of businesses have pivoted their business model such that they no longer need a physical presence in a country to book their revenue on sale of goods and services. Instead, a lot of the sale of goods and services can be done online, digitally, and you don't need a physical presence. And therefore, a lot of jurisdictions feel that even though the companies are deriving revenue from consumers and businesses located in their jurisdiction, they are not getting a share of tax on the profits being earned from these companies, which is why the BEPS project came about. So you'll be wondering, oh, there's a BEPS 2.0. So presumably there's a BEPS 1.0 version as well. So there is indeed a 1.0 version where there were 15 action items where the OECD made recommendations to governments and tax administrations to put in place changes to their existing tax laws to prevent such aggressive tax planning. So you have recommendations like relooking at your taxing rights and the provisions or definitions of what gives rise to a taxable presence, looking at transfer pricing, whether profits are attributed appropriately to the various entities in the group, etc. So after BEPS 1.0 was introduced and implemented, the OECD still felt that the recommendations still could not adequately capture all profits arising from the digitalization of the economy. So they actually came up with BEPS 2.0, which aims to address the tax challenges. So BEPS 2.0, the blueprint came out in October of 2020. And in this past June, the G7 as well as the G20 countries met and they affirmed their commitment to push through this BEPS 2.0. So there are 139 sort of member countries in this inclusive framework group that comes together to discuss how BEPS 2.0 rules should be designed and how it should be implemented. So out of the 139 members, 132 members have already agreed and signed off on the BEPS 2.0 framework. So still 7 countries are pending their response. So I think they are waiting to see, I guess, internally to discuss whether this is something that they would like to agree to. And actually, Sri Lanka is one of the 7 countries that have yet to agree to the BEPS 2.0 statement. So the OECD, I think, is working hard to try and convince everybody to agree so that they get unanimous agreement to the BEPS 2.0 project. And the timeline is such that come October 2021, the detailed design principles and implementation rules will be published. And post October 2021, various countries will have up to the end of 2022 to put in place changes necessary to their domestic legislation or enter into bilateral agreements, etc., to actually prepare to go live with BEPS 2.0 on 1st January 2023. So this is the timeline that we are looking at. It is an aggressive timeline, granted that you have more than 100 countries that would need to put in place changes to their domestic legislation or bilateral treaties in order to implement the BEPS 2.0 framework. So what makes up this BEPS 2.0? It's 2 pillars. Pillar 1 is all about the reallocation of profits to market jurisdictions. So if we look at existing tax legislation, you generally need to have a physical presence set up in the local country where you sell goods and services to, and they will then book the revenues, book the expenses, and you pay tax on the net profits. But under Pillar 1, there's a fundamental shift in how profits will be allocated. So instead of allocating profits to a jurisdiction where you have physical presence, and also through transfer pricing, you allocate profits, whether it's high or low, to jurisdictions where you have entities, and depending on the characterization of these entities. For example, if this is your strategic headquarters where your C-suite people sit, generally speaking, from a transfer pricing perspective or from a business perspective, this is where you expect most of your profits to be sitting. So in your HQ or your strategic hub. Whereas other entities in jurisdictions where perhaps you perform quite limited functions, maybe it's just limited sales or limited manufacturing, you would then, from a business perspective or transfer pricing perspective, put less profits in those jurisdictions. But under this pillar 1, what they are looking at is really looking at the jurisdiction, how much value that jurisdiction gives rise to the entire value chain, and they look at sales revenue attributable to such jurisdictions. So that's why if it's a big market jurisdiction, potentially if you use to allocate a relatively low level of profits to that jurisdiction, because you see that jurisdiction either doesn't have any entity and therefore you don't book any profits there, or it has a entity that's very limited in functions and operations and therefore you book very little profits there. But under pillar 1, you need to reallocate profits of a higher amount to such jurisdiction on the basis that they are a market jurisdiction that gives rise to a high value because of the sheer number of users or consumers that they have in the market. So pillar 1 rule is going to apply to multinationals with a global turnover of above euro 20 billion. So they are starting off with a high threshold because they hope to capture as a start the top 100 companies in the world. So it's not expected to put a lot of pressure on the smaller groups and smaller entities. So it's really their main target is your top 100 multinational enterprises in the world. And I think those will be in the likes of your Amazons, your Googles, your Facebook, or your eBay, where you really have significant global turnover and you may not have local physical presence, but they're able to derive revenue from all over the world. And these M&Es, if you have profitability above 10%, then whatever profit that you have above 10%, you have to carve out 20 to 30% to reallocate to the market jurisdictions based on the revenue allocation key. So notwithstanding that you may not have a local entity in, say, Sri Lanka or Kenya, but if these jurisdictions actually have a significant revenue, then when you do the revenue allocation, these jurisdictions may actually be allocated a certain share of the profit that's now taken away from the global hub or the headquarters and given to these jurisdictions. So it's like rearranging the tax revenue pie to more jurisdictions going forward. So the market jurisdictions will be determined based on a special purpose nexus rule. So generally it's going to be if you have at least euro 1 million in revenue from that jurisdiction is likely to be in scope and stand to get a share of the profit reallocation. So the details of how you're going to determine what's the formula to allocate the profits, how should you be computing the profits in the first place. The details are not out yet, So we're expecting come October 2021, that's where the details will be published. So if you take profits away from currently where they sit, for example, your strategic hub, and you give them to various different market jurisdictions, then there will be double taxation, right? Because you'll still be reporting those income in your hubs. So by doing this reallocation, countries all need to agree that the hub will then have to give a double tax relief to the company if it's suffering taxation on the same amount of income. So under the Pillar 1 rules, there will also be details of how double tax relief will need to be computed and then granted by the residual profit earners going forward. And as you can imagine, if there's many jurisdictions that's going to get a share of the profits and the rights to tax such a share, then there could give rise to a lot of tax controversy and dispute. How do you determine that's the right share that you're allocating to country A, B, and C? Can they dispute and say they deserve more? So there'll also be procedures under the Pillar 1 details to talk about what kind of dispute prevention and resolution mechanisms are available for the entities that will be impacted by this Pillar 1. So if you sign up for Pillar 1, you actually have to agree to remove the digital services tax that if you have introduced. So for example, in Kenya or in India, where they have some sort of digital services tax, or in a lot of the European countries where they have come up with digital services tax. Now to catch the non-resident suppliers of digital goods and services, if you sign up to Pillar 1, you actually have to put in place a mechanism to withdraw such digital services taxes from your current tax legislation. So you would expect countries like India, if they sign up to Pillar 1, then they have to relook at their equalization levy, whether this is called a digital services tax, and how do they then withdraw such digital equalization levy from their legislation. Similarly, you have the UK, your Spain, and a lot of European countries and some African countries that have introduced digital services tax. Again, if you sign up for Pillar 1, then you have to put in place mechanisms to withdraw such digital services tax legislation. So under Pillar 2, this is an optional pillar, and the main principle is really ensuring profits are subject to at least a 15% global minimum tax. So if you are a multinational group that is in scope, so if you have global turnover above 750 million, then you would look at your legal structure and you look at your financial statements and you look at, okay, what is your effective tax rate that you suffer for each of the subsidiaries or your investments if you control such investments, and it's all consolidated into your group annual reports, then whether the effective tax rate at these subsidiary levels meet at least 15%. If they don't, then you have to pay a top up. So how it works is, if let's say it's I'll just use Singapore as an example. If it's a Singapore headquartered company and it has subsidiaries in, say, Sri Lanka, in Malaysia, in Thailand, and then you need to compute what is your effective tax rate that you're paying in Sri Lanka, in Malaysia, or in Thailand. If, for example, in Malaysia, my effective tax rate is only 10%, but the minimum tax rate is 15%, I have to pay the differential of 5% at Singapore, which is my ultimate parent entity level, if Singapore adopts this rule. And if, say, Thailand's effective tax rate is 17%, then you already above the minimum tax, so you don't need to top up any payments. Then depends on Sri Lanka, if your effective tax rate is higher than 15%, there's no top up that you need to pay at the Singapore level. But if it's lower, if, for example, the Sri Lankan subsidiary enjoys a tax incentive, then you need to pay a top up to at least 15% at the Singapore level. So in a nutshell, it's really to ensure that whatever the multinational enterprise, wherever they are earning their profits, these profits will be subject to tax at least 15%. So there are two different types of rules. One is the income inclusion rule, which I talked about. So in my previous example, Singapore will be the one which will be collecting the top-up taxes. It's under this income inclusion rule. If, let's say, Singapore itself, its effective tax rate is lower than 15%, then another rule will kick in, which is the under tax payment rule, or what we term as UTPR. Then they will look at whether you have any related party transactions. And if you have related party transactions and you are not paying the enough top-up taxes, then the jurisdictions can actually deny a deduction or impose a higher withholding tax rate such that they collect the top-up taxes through that mechanism. So again, we are waiting on the detailed implementation rules of how exactly do you compute the effective tax rate. I think you will start off with financial statements, but what kind of adjustments will be needed to be made? For example, from an accounting perspective, you may have certain adjustments. And then what is the rules to determine and compute income inclusion top-up, as well as under tax payment rules top-ups. So if you are an MNE with global turnover above 750 million, you'll be in scope. But there's also a catch. So any jurisdiction, you can actually opt to impose this rule on the multinational groups that is actually headquartered in your jurisdiction, regardless of whether they hit the global turnover of at least 750 million. So potentially, depending on whether jurisdictions will opt to impose this rule, the multinational groups, even if your global turnover does not meet this threshold, you could potentially still be subject to Pillar 2. So there are entities that will be excluded, which your government entities, your international organizations, non-profit organizations, pension funds, as well as investment funds. There's also exclusion for international shipping income. And the reason why these are excluded is because they are either not the targets of what the OECD wishes to catch, because these organizations usually are either non-profit, so really aggressive tax planning is not what they are after, right? It's really like your non-profit organizations, they wouldn't have any profits, it's non-profit. Your investment funds generally will be quite regulated, or it's earning relatively passive income. So there's little room for these entities to shift their profits around with aggressive tax planning. And for shipping groups, generally they are subject to tonnage taxes. So again, these are some of the groups and entities that are really not the targets of what the OECD wishes to capture. So besides the income inclusion rule and the under tax payment rule, there's also this subject to tax rule. So the OECD recognizes that some developing countries will have resource and cost constraints to implement such complicated rules, and therefore they allow developing countries to request for this subject to tax rules to be included in their bilateral tax treaties. So how this will work is the developing countries can take a look at what kind of payments the entities in their jurisdiction are making. So if you make related party interest payments or royalty payments and a defined set of other payments, and if you know those payments are going to be subject to quite a low tax in the counterparty jurisdiction, the developing country can actually request that the withholding tax be higher than under the treaty. So for example, if say Singapore and Indonesia have a tax treaty and royalty rates are subject to 10% withholding instead of the 20% Indonesia domestic tax rate. But Indonesia knows that this royalty payment, when it's made by the Indonesian entity to the Singapore entity, the Singapore entity subjects it to tax at only, say, 5%. So this is below the minimum tax of between 7.5 to 9%. And therefore, Indonesia has a choice to say, I want to then make a higher withholding tax of up to 20 instead of the 10% under the treaty. So this is what's going to be allowable under the subject to tax rule. So that's really how the two pillars will be working under BEPS 2.0. So I've put down here an illustration of the globe rules under Pillar 2. So in this illustration, we have an ultimate parent entity in Sri Lanka, and it has several subsidiaries. In one of the two subsidiaries, actually, one in Hungary and one in Vietnam, are low taxed profits. So if Sri Lanka elects for this globe rules, then the differential between 15% minimum tax rate and whatever the Vietnam entity and the Hungarian entity is paying, the differential and the top up will then be collected by Sri Lanka at the ultimate parent entity level. So this is how the globe rules is going to work. So if let's say the ultimate parent entity in Sri Lanka, actually it itself is low taxed, then if it makes related party payments, then the other counterparty could actually deny a deduction so that they collect the shortfall via a denial of deductions as well. So potentially two avenues of collecting the shortfall of taxes. So then you ask, how does this then interact with digital services tax? So in the past, before we came with BEPS 2.0, a lot of countries are already saying that it's taking the OECD too long to come out with this global consensus on BEPS 2.0. So a lot of the countries have introduced their own unilateral taxes, and a lot is either in the form of a digital service tax, which is tax on revenue derived from specific digital goods and services, or dependent on the number of digital users in the jurisdiction, or they could also collect it via GST or VAT. That means requiring a non-resident entity selling into a country to register and collect GST and VAT. So if you sign up for BEPS 1.0, what's going to go away is this digital services tax, which is the tax on revenue. It's generally levied on gross revenue, a flat rate. So if you meet a certain threshold of gross revenue or sales, it's going to be applied on your gross revenue and sales. And it's not considered an income tax. It's a unique class of tax on its own, so it's generally not creditable. So that means companies actually end up with double taxation. And DST is usually imposed based on, they look at what's the number of users or number of sales that you have in a local country. And it's generally targeted if you provide digital services or goods, like your, if you have download, if you allow for download of online magazines or online TV show streaming, or you do online advertising. So some examples of the countries that have introduced digital services taxes is I've given two. So one is Spain. They have a 3%, which is levied on gross income on Spanish in-scope activities above a threshold of 750 million euro annual revenue, and you have annual revenue of 3 million euros generated from Spain itself. So if you meet this threshold and you are providing activities such as your online advertising or online intermediation, which is a platform that allows buyers and sellers to meet and you earn a commission, then you're in online intermediation. Or you do sale of data, user data. So you do data transfer services. That's also in scope. So if you are companies involved in such activities and you meet the threshold, then you need to pay a 3% tax on your gross income. So notwithstanding that you may be losing money, your profit margin may be less than 3%, but the 3% will still be levied on gross income. So in Kenya, they have also introduced this digital services taxes in January of 2021. So theirs is slightly different. Theirs is 1.5%. And it's levied on gross transactional value derived by either a resident or a non-resident person from the provision of services through a digital marketplace. So if, let's say, you provide a platform that allows interactions between buyers and sellers of the goods, then you earn a commission and you have to pay 1.5% on the commission that you earn from such facilitation. And if you are the digital seller of goods and services, then you will have to pay 1.5% on the gross transactional value. So whatever your consideration you're getting from your sales of goods and services digitally, then you have to pay that 1.5% tax. For Kenya, there's actually no threshold. So unlike Spain, where there's a sales threshold, in Kenya, there's none. Right? And the compliance will be by way of withholding. So I think they'll be appointing withholding tax agents, very likely maybe your payment gateways, who then gets the money from the buyers and sellers. And they'll be the one who then have to withhold and make that payment to the authorities. So really, what does BEPS 2.0 bring about? If BEPS 2.0 comes into effect in 2023, then countries which currently have digital services taxes have to give them up. But currently, it's still unclear what falls under digital services taxes, because there may be different variations or nuances depending on the countries and how they have introduced them. So what is in scope? What is the timeline to remove such digital services taxes? So all these were pending the details. And notwithstanding that you need to remove such digital services taxes, will there be other forms of taxes that will be introduced? Because this has been quite a good revenue generator for some countries, especially in the past, it was very hard to tax the non-resident suppliers of digital goods and services. But with digital services taxes, you actually capture a portion of such tax revenue. So getting countries to give this up may take some convincing. So I think we'll have to wait and see what kind of coordination needs to be in place for the inclusive framework members to agree to remove the digital services taxes. Then for members who have yet to sign on to BEPS 2.0, whether in the meantime, since they have until 2023 before BEPS 2.0 comes into effect, whether they will still be considering digital services taxes in the meantime. That's also something that we are actively just monitoring. And with these, whether tax controversy will increase, given that you have, if you have countries that have unilateral taxes introduced, then whereas some countries will have them BEPS 2.0 rules, then how do these all interact? And what kind of tax controversy will then arise? And this may be a cost to businesses. So really from an impact on business perspective is, will you be at the winning side or losing side of BEPS 2.0? So for some market jurisdictions, maybe in the past you have very little revenue, but now under BEPS 2.0, you'll be allocated more profits and therefore more tax revenue. So you may end up as a winner. Then the losers will be those where it could be your strategic hubs where you used to book in all the residual profits, but now you have to carve it out to give to market jurisdictions. So whether it will end up as a winner or loser, how does that impact the economy? And then with BEPS 2.0, if there's a minimum global tax, you have to pay a top-up tax at the ultimate parent entity level. Will tax incentives still be attractive? Because even if you give a tax incentive to attract a company to set up presence in your jurisdictions and they pay very little tax in your jurisdiction, but they still need to pay top-up tax at the parent entity level. So does that then negate the attractiveness of tax incentives? Whether businesses will then relook at where they set up physical presence, whether they will look at their existing structures and restructure, how much of the impact will that have on their resources and headcount, because you have to do a lot more tax reporting. Then with the increased tax bills, what would happen to the stakeholders and the shareholders? How do you manage that? So all these will be potential impact on businesses as well as governments as they then look to see whether any calibration of their tax regimes need to be made in order to make them still attractive locations to attract foreign direct investments, as well as not to increase the burden of the multinationals that are headquartered in their jurisdiction as well. Yep. So that's like a 40-minute overview of BEPS 2.0 and digital services taxes. So hopefully this gives a appreciation of what's coming. And we have a Q&A session later where we can answer questions as well. So once again, thank you very much for your time. And I hope this gives a good overview of BEPS 2.0. So back to you, Sulaiman.
Yes, hi. Hi, everybody. Thank you, Sini, for that elaborate but concise explanation on a complex subject like DST and BEPS 2.0. Before we, so I'd like to introduce or welcome both Sinyi and Abbas Kamadin to the panel to join me on the panel discussion and the Q&A. Unfortunately, we have had Dr. Kapila excusing himself due to an unavoidable urgent situation that he had to deal with. So we apologize to all the participants for his absence. But Abbas has kindly agreed to join the panel discussion to take it forward. So please do send in your questions to the Q&A box, and we'll take them as and when we proceed. We will have a panel discussion and accommodate any questions that come up as well. So to start off with, I thought I will just take you through a bit of background to sort of summarize the whole thing in a more simplistic way, if I may. So from a Sri Lankan perspective, of course, I mean, we had a discussion with FITIS on this, and from a national point of view, we do have two burning issues at the moment. One is our foreign currency reserves are at an all-time low, and we also do have a revenue shortfall, primarily due to COVID, and one could say it's no real sort of fault of anyone, but we've been with COVID now 1.5 years. It has had a significant impact on the economy, especially tourism, which has resulted in some of these shortfalls, both in terms of foreign currency and income, right? So given that current situation, we have also seen a significant advancement in digitalization, of how goods and services are procured by the Sri Lankan market. Right? So it's not, there are a lot of people purchasing goods and services online where the recipients of those profits and revenue are not in Sri Lanka and have no taxable presence in Sri Lanka. So as a result, we have two problems which are sort of making the situation rather worse. One is you have a foreign currency drain on the economy as a result, plus you have an erosion of your tax base, where if those goods were procured or services were procured from Sri Lanka, if they were available at all, you would have a higher tax base where those transactions would get taxed in Sri Lanka. So given these two issues, in terms of goods, so not only do you lose out on your VAT and income tax, in most cases, customs duties are also not imposed because these are sort of personal items that come individually. Right? So on that count, we have a revenue loss plus foreign currency loss hitting the economy as a result of this digitalization. So to counter this, many countries, like Sini clearly explained, have come up with unilateral approach of imposing a digital services tax or something similar. For example, expanding the scope of VAT. Now, currently, our VAT law only allows you to impose VAT on somebody who has a business presence in Sri Lanka. If you don't, you're out of scope, right? So some have expanded that scope, and we can do that as well. And whether we should do that is the whole point of this discussion. Open up that scope to see if we can bring in those who are deriving revenues and profits from Sri Lanka into that scope. And Singapore, I believe, has done that, and we'll run through an example with Sini shortly. So this has caused, so this digital services tax is basically imposed on the importation of these services where your accessibility to it is digital. So you don't walk into a shop and purchase the goods and services, but your access to it is primarily from digital sources, right? And its coverage is the consumers within a particular territory. So in this case, it will be the consumers of Sri Lanka, and the tax base is the revenue generated within a territory, right? So it is rather simple, and we do have something close, which is that stamp duty of 2.5% that has been imposed on credit card payments, right? But that only captures personal payments because it goes through credit cards, and it doesn't cover payments made by businesses, for example, where it doesn't go through a credit card. So to that extent, we do have something, but we are kind of falling short on some of the major payments. So in the globalized economy, it is important also to have consistent, coherent rules, and that's what DST has come and sort of changed a bit. And these rules are generally where you ensure an appropriate allocation of tax amongst jurisdictions. There shouldn't be double taxation. It should encourage international trade and investment, and this uncertainty at the moment, whether it's digital, whether digital is going to come or not, those uncertainties affect investment and trade. And also, like Sini said, the avoidance of controversy with tax administrations. There shouldn't be a conflict between tax administrations that they want a higher share of the pie of the profit. And for that, these coherent rules are extremely important, and which is what I think the BEPS 2.0 is trying to meet. So yeah, so with that, let's move into our first question to Sini, just to give some perspective. I mean, she did cover this in the presentation, but Sini, what is the why can't the traditional tax rules, why can't we use them to tax it? Can you explain the traditional method of taxation of goods and services, and why the digital services does not get captured in the current framework?
Yeah, sure. So your traditional type of sales of goods and services is you actually need, generally you need maybe a brick and mortar store where you sell the goods, or you need a place where consumers then walk in to ask for a certain service. And to have that physical presence, you need generally to set up a legal entity, be it a branch or a private limited company. And then where you have sales of goods and services, that's where you book your revenue and your expenses. And then you have your annual returns and reports. And you submit your taxes based on your financial statements for that year with certain adjustments. But with the advancement of technology, so now you see a lot of the companies or businesses actually can sell goods and services online. So for example, you log on to your Amazons or your online shops, and then you purchase a book. It may come from the US or UK. You pay via this payment gateways. So you just supply your credit card details, or you create a PayPal account and you make payment online, and the goods are then shipped to you. Or if you want a service, for example, I want to stream certain music videos or movies or books, again, you go online, you make a purchase, make the payment, and you download the movies or a certain service, and that's streamed online. So there's actually no need for that supplier to set up a presence in, say, Sri Lanka, to then book the revenue and then pay tax on it. So that's where a lot of the jurisdictions are saying, hey, even though consumers in my jurisdiction are buying a lot from such suppliers, these suppliers are actually not paying any tax in my jurisdiction. They're all just paying taxes in their state. So overall, their tax collection, they feel that it's not appropriately collected. So I think this is where the dilemma comes in, and that's why OECD wants to relook at how the taxing rights should be given to all the various jurisdictions.
Right. So just so that our audience understands, Sini, we haven't experienced it here too much, but so as a result of this, Singapore went ahead and then imposed something similar to a digital tax by, I think it is a GST. If you can just explain to us with an example of how, for example, a composer of music in Sri Lanka were to sell music to a consumer in Singapore, how would they get impacted by the current sort of DST or similar regime in Singapore? How would the Sri
Okay.
Lankan company get affected?
Yep. So Singapore doesn't have the traditional sort of digital services taxes regime. So instead, we have this called the Overseas Vendor Registration Regime. So if you are a non-Singapore supplier of digital services, okay, so if the non-resident suppliers of the digital services to Singapore consumers, if the revenue from Singapore consumers cross 100,000 Singapore dollars, and your global revenue crosses 1 million Singapore dollars, then you need to register for Singapore GST. So you then need to impose GST on your sales made to Singapore consumers. So this is how we attempt to capture the revenue from such non-resident suppliers. It's also to give a level playing field to the domestic suppliers, because if you are a consumer and you buy from a non-resident supplier, you don't need to pay GST in Singapore. But if you buy from a local Singapore supplier, you need to pay 7% GST. Then there's an incentive for consumers to actually buy from the overseas supplier. So this besides collecting more taxes, is also to give a level playing field to suppliers and not disadvantage the local suppliers.
Right.
Yeah.
So moving to Abbas, Abbas, from a Sri Lankan digital industry standpoint, would you recommend a taxation on foreign digital service providers. Just like Sinyi said, who currently pay no tax, although generating revenue and profits from Sri Lanka, at most times at the expense of local businesses. Your thoughts, Abbas?
Sure. Thanks, Sulaiman. So it's quite a complex and complicated situation when it comes to the local context. I think we have been discussing this matter with various different state bodies, with various different from ICTA to the EDB to Finance Ministry to etc. Various formal and informal manner. And I think it's quite a complicated situation and a complicated. I think there isn't a simple answer to it. So let me just kind of explain the background behind it. So Sri Lanka has kind of clearly identified that the need for digitizing our economy is going to be an absolutely critical element of economic prosperity, as well as developing the quality of life of the people of the country. And in line with this, I think the fourth industrial revolution or Industry 4.0 is being kind of rolled out across the country, or at least initiatives have been taken to roll out Industry 4.0 across the country to address this productivity issue. Now, one of the key elements when you're doing that is that measuring the digital economy of the country. So if you take Sri Lanka today, we are relatively behind. We are at about I think we are less than 5% of our GDP in terms of the value of the digital economy is less than 5%. Globally, if you take, you're looking at something anywhere between 18 to 24%. And, even countries like Malaysia have a very high digital economy rate of maybe 35% of the GDP. So saying that, there's a lot of work, and there's a lot of, even with the industry, even with FITIS and other industry bodies, there's been a lot of effort going in to educate people about the importance of digitizing or moving to developing our Sri Lankan digital economy. And that will help in terms of the whole economy grow and will help Sri Lanka to move towards economic prosperity. Now, when you bring in any form of tax, that automatically creates a negative point, in whatever sense. In whatever sense, it creates a negative factor for growth, right? I mean, that's essentially, unfortunately, that's something that's unavoidable. So the question is that I wish it was a simple yes or no, but I think in a Sri Lankan context, it needs to be looked at in a lot more in detail and figure out how do we get the best out of it, and how do we make sure that we don't get affected in terms of the negative elements of taxation. So in line with that, there are essentially 4 key elements that we need to keep in mind that would impact, that any form of taxation would impact. One, of course, like we mentioned, was the whole aspect of the impact on the digital economy growth, right? That's going to have an effect whether we like it or not. Another one would be, in some sense, Sri Lanka being a small country, there are certain global services, global digital services, which the country needs. One example that is obvious to all of us is maybe, like for tourism, hotel bookings and other tourism related sites. So these are something that would have an impact directly on those industries if in any way we were to burden them or anything like that. So that element needs to be considered. The impact on non-availability of various global services which are important to our certain key businesses within Sri Lanka, or economic industries within Sri Lanka. Of course, on the other side of the coin is the opportunity loss in terms of creating local, regional, or global enterprises, digital enterprises, that is. So by bringing in, by kind of leaving everything open and allowing anyone to kind of operate in any way that they want to, yes, you've got access to digital services more than ever before, but you're also restricting from local startups to thrive and local startups to get going. And of course, like you all discussed, there's also a revenue loss in terms of taxation, and also there's a revenue loss in terms of foreign currency. So these are the 4 key elements that at a ground level that we need to consider the pros and cons. And I think these need to be taken into consideration when looking at not whether we tax or not, but more of who do we tax, how do we tax, and where do we tax. Those questions need to be answered based on these criteria that need to be evaluated. So that's to summarize on what the question that you had. I hope I answered it.
Yes, definitely, Tabas. I think that brings in the complexity as to it shouldn't just be a blanket thing. I mean, we need to look at what's good for us, and then pick and choose, and probably bring in some thresholds, and then exempt a few who are actually benefiting the economy, for example, right? So just moving back to from a tax point of view, Sini, I think DST, just sticking on to DST again, has been considered a bit controversial from taxing circles. As to its being unilateral. What are the issues with the DST, the cons, if I were to say?
Okay, so it is a tax on revenue, so it's a top line tax. So it does not take into consideration that businesses may not be making money on the supply of these digital goods and services. Yet you impose this tax on them, so it makes it even harder for them to turn a profit. Right, so that could be controversial, and it's not considered an income tax because it's a tax on revenue or on turnover. So you can't get double taxation relief. So for businesses who have to suffer digital services taxes, it's like an additional cost to their operating costs. So that again, that's why it's controversial. And it's also political because the digital service taxes was introduced by, I think, the European countries first, and thereafter it spread to other regions and other countries. And the initial main target is really your big US multinationals. And so the US has reacted to say that these digital services taxes are unfairly targeting their companies, and therefore they want to impose tariffs on countries which introduce DSTs. So I think this has led to a lot of trade tensions as well. So it's also controversial from a customs and overall operations or business perspective.
So we'll just take a question from the floor. One is when this proposal is going to be effective, and why did Sri Lanka not sign up for the OECD proposal? So on the first one, I think Sini said it will be the target is 2023. That is the BEPS 2.0. DST, of course, is discretionary. The government can bring it in budget this year, even if they want to. But the OECD will be in 2023. The other question was, why didn't Sri Lanka sign up? So from what we understand, Sri Lanka wanted more time to look at the implications of it overall from its policy of attracting investment into Sri Lanka and the tax holiday policy that they had on it, and how it will really impact. So they're doing that study at the moment, and since there is still time, they are going to go into it, and then probably they'll decide which way to go, whether it's they accept only a pillar 1 or is it pillar 1 and 2 is something that they are working on, is what we understand at the moment. Abbas, just coming back to you. So since we haven't got a consensus on this BEPS 2.0, whether we are going in for it or not, in the meantime, imposing a DST which has been very successful in some other countries, raising significant revenue, do you think it's advisable, based on your first answer, we do it, we do a proper analysis of it, see which segments we want to actually target, which will probably bring in the revenue without impacting our economy too much, and then phase into the BEPS 2.0, or should we do you think just wait it out, forget about the DST, and then work towards the BEPS 2.0 only, and miss this 1.5 years of potential revenue?
Well, I think we need to really look at the customized solutions. The challenge with the DST is that it would probably it is required in some sense, but we also have to mitigate the negative impact that DST would have throughout this period. So, for example, if I was to take an example, if we were to bring in DST, I mean, Sri Lanka is a small economy comparatively. And if you have certain global players who we need, for example, maybe certain payment platforms, maybe certain, like I said, tourism related platforms which bring in tourism, other related platforms. Now, if these platforms were to be discouraged because of DST, I think we are not doing justice in some sense. So I think it's important to actually understand and to pick and choose in some sense. And maybe you can use instruments like BOI, maybe some other factors that you could use, where you could probably or you could use some form of a whitelisting criteria to say, okay, these are services that we do need in the economy, and maybe that could be exempt from tax, and then bring in some form of a DST, or maybe look at it in that manner. But I think that holistic approach needs to be taken. So, and especially, I think the biggest challenge that needs to be addressed is that I think more than the DST, I think some of the bigger platforms that have global presence actually don't ensure that the local upcoming startups don't actually have a level playing field, right? And that can be easily done. You don't really need to have, it doesn't need to be financial or taxation related. You could have so many variable methods of making sure you use that dominant space to dictate terms in any economy. And we've seen that. Frankly, we've seen that. I'm not going to take any examples here, but we've seen that. So I think there has to be a system in place within any economy to actually protect that as well, to ensure that the local players, the local startups that are coming up are protected from anti-competitive practices. I mean, you take Europe, for example, you've got, when an industry is dominated by too few or maybe one or two players, the legal kind of framework comes in, and, they're not allowed to grow and dominate any further. So in some sense, I think you need to make sure that there are systems and structures in place within the economy to protect the smaller players from getting in there and growing and being a competitor to the big global players. And for those global players that don't really add any value whatsoever, and that is something that can easily be replicated by a local startup or by a local entity, I think that's where maybe DST would be more applicable. So that's my thought on it.
So we'll have to have sort of a list like the exempt list we have in a VAT schedule at the moment, VAT law. So Sini, practically, I think good point by Abbas. I mean, for a developing country like us, maybe not so much for Singapore, but Singapore also is not a very big market, right? I mean, population-wise, although high value, I wouldn't say the numbers are very attractive to an outsider. Perhaps maybe because of tourism numbers. So in that context, has Singapore brought in any rules in terms of who should be included or excluded? It's a revenue threshold, and nothing more is looked at. And also, if you could just add, how successful has DST been as a revenue source for Singapore? Has it been attractive or not that material?
So for the GST that we put in place, I would say it's not really aimed at collecting a lot of revenue. I think it's more aimed at having a level playing field and not disadvantaging the local suppliers of the digital goods and services. So to make it more fair. And it hasn't been like a big revenue generator just because I think the Singapore market is so small, right? So I think it doesn't move the needle a lot. Yeah, it's more really leveling the playing field. And from a BEPS 2.0 perspective, we have signed up for it. I think for under Pillar 1, we are likely to be a net sort of loser, for lack of a better word, because our market is so small, so we wouldn't be allocated much out of the reallocation of profits. And a lot of companies actually have regional headquarters or hubs in Singapore. So this is where traditionally a lot of the residual profits may sit in Singapore. So if this is going to be then carved out to all the bigger market jurisdictions, then I think net we expect there to be a outflow of tax revenue. Yeah. So I think we will then have to concentrate. I think that's where the Singapore government has been looking at what makes sense for Singapore. Of course, we've always said that our tax incentives are based off substance. So to set up a hub in Singapore, you need to have a certain level of headcount, certain level of strategic people, certain level of business spending, etc. So we're not your tax havens or your cash box or pattern boxes. So it's really substance based. But again, with the BEPS 2.0 minimum global taxation, so with the government is working hard, I think, to see what changes needs to be made to the tax incentive regimes, as well as our, I think, your tax legislation itself, just to remain attractive to foreign direct investments. So of course, tax is just one factor that businesses look at, right? They also look at what's the infrastructure, what's the competency of labor force, other factors. So we believe that we do have strong fundamentals. So working on that as well to continue to attract foreign direct investments.
Right. So the incentive there for a headquarter would be less than the 15%, is it? If you take without effective.
Yeah.
So that way it will get impacted to some extent, right?
Yes, they will be impacted if they are across the thresholds as mentioned. Yeah.
So Abbas, just going on to this, like you said, I mean, also as consumers, we do derive a lot of facilities from these digital providers, right? For example, from Apple to Amazon to, we get a lot of global sort of high quality goods and services available to us. So having that quality competition is necessary to ensure that the local industry also does thrive. I mean, you can't have a protectionist sort of regime, but like Sinyi said, it should be a level playing field as well, so that we have enough competitive room to actually grow, because we are much smaller. So in that context, don't you think that introducing a tax such as this would affect that expectation of being able to sort of have sufficient competition to grow and become global?
So, Sulaiman, I think competition is actually a key word. I think competition, without competition, whether we like it or not, I don't think any organization could actually be able to compete globally. I mean, to have the necessary levels of competition locally is what brings you to that level where you can actually start competing globally. So it's absolutely important that we do have competition that is at a global scale and a global level. And in that sense, yes, sometimes DST could have an impact in terms of competition, and of course the customer experience also gets affected there, therefore. But I think that also, but if you completely leave it open, what most happens is that, like I mentioned earlier, most of these global players have practices which don't allow new entrants to easily get into that specific space. So I think it's important that while you're having competition open, first of all, there's also the responsibility from a government point of view to ensure that there are enough incentive structures in place, there's enough support in place for the local ecosystem also to kind of, be able to operate in these spaces or in these different verticals. So that's absolutely important, and I think that's the responsibility of any government across the globe to ensure that they are having the support structures and the incentive structures for the local startups or the local ecosystem to be able to thrive against the large global competitors. And I think the competition being there also gives a great benchmark for the local players to be able to expand from local to regional to global. And I think so that it's important to kind of have a proper balance between these two. And I think what's most important is, like I mentioned earlier, is also make sure with the global superpowers and with the global power that most of these global players hold, that they are not allowed to involve in any anti-competitive practices, right? And as long as that is strong, maybe anywhere from all the different authorities, like you got the consumer authority, you got various different authorities involved. As long as they get involved and ensure that anti-competitive practices are not allowed, I think some form of competition is always good.
All right. So coming back to this pillar one, Sinyi, the fifth, now that this has been agreed globally, could you briefly explain how the implementation of pillar one would differ from a typical DST or something similar? And would it facilitate to implement the rules I discussed about avoidance of double taxation and appropriate tax for each jurisdiction? How would it differ from a DST, the pillar one?
Yeah, so DST is actually you look at sales revenue that you make into a jurisdiction, and depending on different countries, they have different rules. Some don't have a sales threshold. Some will have a sales threshold based on your global turnover and then your local turnover, and then the rates are also different. Whereas under Pillar 1, I think you look at, notwithstanding, it doesn't really just capture digital goods and services. I think once you hit the global turnover, which is currently set at a very high threshold, 20 billion, and you need to have profitability or profit margin of above 10%, then you will be subject to Pillar 1. So I think it recognizes that you want to tax businesses, but that business needs to be profitable in the first place for it to then reallocate its profits. Then that's fairer, as opposed to a digital service tax, which just wants that business to pay tax on top line gross revenue without recognizing whether they are in a net profit or loss position and what the margin is. And the allocation under Pillar 1 is going to be based on sales revenue. So there is some element of sales. So they'll be looking at what's your overall sales around the world, and then which are the big market jurisdictions. If they are in scope, then the profit margin that needs to be carved out will then be allocated. Presumably, I am just thinking mathematically, maybe based on the proportion of the local jurisdiction sales over your global sales. But the details are not out yet, but I'm just thinking if they want to go simple, maybe this is a formula that they may use, but we'll get to know about it come October. Yeah.
So this is based on profitability, just like income tax, whereas the DST is solely on sales.
Yes,
so
correct.
whether you make profit or not, you have to pay a DST, whereas Pillar 1 is only if you are having a significant residual profit globally, will it get spread amongst other market jurisdictions.
Correct.
So that's
and yeah, and digital services taxes is unilateral, so we expect there to be quite a lot of potential tax controversy. And again, it's not a tax that allows for foreign tax credit, so it's actually a cost to the business. Whereas for Pillar 1, it is a income tax, and they're supposed to provide a tax credit by the residual profit earners. And there will be a sort of like a multilateral instrument that all the countries who signed up for BEPS 2.0 to sign up to this multilateral instrument, wherein then you pledge or you agree that if you are a country that actually will have profits that's carved out, then you need to give credit to the business. And the other countries will also have to abide to the rules per the multilateral instrument. And there is a mechanism for businesses to seek confirmation or upfront confirmation of how much they should be allocating to each jurisdiction, so that this hopefully will decrease the amount of controversy of jurisdictions arguing how much they should be getting.
So there's a question in the Q&A. If a country does not comply with the BEPS, what are the potential penalties or sanctions? Is there any penal provisions at the moment, or you just might get isolated and left out, I suppose?
Yeah, so currently there's no penalties or sanctions. So it's really, I think it's up to each of the countries to then weigh the pros and cons of whether signing up is beneficial in the long run for them, or they'll prefer not to sign up. So notwithstanding that you don't sign up, I would think that if you don't sign up potentially under Pillar 1, then you may not then be entitled to get a share of the profits that's going to be reallocated. Yeah, then under Pillar 2, I think it's still unclear right now, but we suspect that, let's say, even if you don't sign up, if an entity in your jurisdiction doesn't meet that effective tax rate of 15, that profit will still anyways be taxed in the headquarter or ultimate parent entity jurisdiction in any case.
Abbas, you know that this currently we have this 2.5% charged on credit cards for any payment made out. That is more a charge on sort of personal, and then it's a charge on the payer rather than the person making the income. In your view, do you think that this for the time being is sufficient for now without upsetting the apple cart too much, and we work towards a proper policy like we discussed earlier on who gets excluded, and we take our time on it and rely on this 2.5% for now? Is that something, or should this be increased or decreased to avoid any complexity or rocking the boat at the moment?
Well, I think, frankly speaking, definitely a more holistic approach needs to be taken than this 2.5% on the credit cards. Frankly, I don't think it's adequate in any sense, and I don't think it helps too much either in terms of you've got certain key payments that you would need to make, simple things like even basically your requirements for cloud space. You know, when you pay it, you're actually getting taxed, which is incentivizing someone from actually, you know, digitizing, right? So simple things like that, maybe for an organization that probably saves 30-40% in productivity by using a cloud-based accounting system, would be intensified because of the small tax. So I don't think that's the way to go, frankly. I think that we need to look at it a bit more carefully and understand it. And we need to maybe look at it in terms of, you know, bringing in some system in place for sure. It's not going to take too much time if you know, the right people are put together and, you know, some form of system is crafted. And I think more importantly, if it was like Singhi mentioned, if it is purely on the purpose of leveling the playing field, and if that context is taken into you know, consideration, I think we could come out with some system in place very, very soon until BEPS is introduced. And I think that would be, of course, would be the ideal thing when that happens, because you wouldn't have any friction, you wouldn't have any repercussions from other economies reacting to it, like what we have in DST. And, you know, it would be a uniform and a unilateral thing. So I think that's something that we definitely, I'm not saying we are 100% for it. We need to still discuss it a little bit more, maybe once we get more details. But I think that seems to be the way for us to go. But the 2.5 is not, at least to me, it's not a stopgap measure for sure. I don't think that's the best option for us to go until then.
On pillar two, Sydney, there has been some confusion. I think you explained it, but if you can just reiterate, this minimum 15% is not a rate that needs to be imposed by any jurisdiction, right? So it is a minimum effective rate that needs to be paid in the country where the group is headquartered. And considering the effective tax paid in each country, you did it through an example. If you can just show that again now, for example, if you have, let's say, a multinational investing in Sri Lanka,
Yep.
and Sri Lanka were to give a tax holiday to that entity. So pillar two, signing up to pillar two would mean that whilst Sri Lanka can still give the tax holiday, they wouldn't pay in Sri Lanka. But ultimately, in the US or wherever this multinational is headquartered, it can't get away from a minimum tax of 15. So that will move to. So whether the question is that the correct understanding?
Yes, that's right. So for example, if you have a US headquartered group that has a Sri Lanka subsidiary, and Sri Lanka gives a tax holiday, so 0% tax. If say US has already adopted this BEPS 2.0, and the minimum tax rate is you have to pay a minimum of at least 15% in each jurisdiction you operate in. So in Sri Lanka, if it's currently at 0, you have to pay 15. So there's a 15% differential and the top up, which needs to be paid at the ultimate parent entity level if the ultimate parent entity has elected for BEPS 2.0 and for the income inclusion rule. So in this example, then that 15% differential will then be paid to the collected by the US.
Right. So just to add to that, Sri Lanka currently has not signed up because of their worry, and they want to actually analyze their FDI policy in terms of getting these holidays in. And so I believe whether Sri Lanka signs up or not, any company headquartered outside would end up paying this minimum 15% in that country, despite Sri Lanka's exemption or not, and whether they sign or not. So it doesn't really impact our decision, is what I'm thinking. Is that right?
Yeah, that's based on the reading. I think that's also what's my understanding. Yeah.
Right. Right. All right. So that means, so if we don't sign up and we do give a tax holiday, that company would ultimately have to pay at the US headquarter level on their consolidated profits globally, and Sri Lanka will technically lose out as a result of the holiday, but the company has to pay that minimum 15% anyway.
Mm.
So
Yeah.
I think it's to sort of equalize it at some point is the purpose of pillar two. So that is interesting. So it makes a holiday regime technically of no use.
Yeah,
Um,
much less
the
attractive going
global
forward.
mindset, right, where you want to invest.
Yep, that's
Abbas,
right.
we'll just take one more from the yeah, so there is this question: are the tax havens such as Panama or Isle of Man or potentially Port City in Sri Lanka, can they be excluded? I don't think anyone is excluded. You all have to. I think, and some of these tax havens have already signed up for a BEPS 2, right?
Yes. So if you look at the list, Panama and Isle of Man has actually signed up for this.
Mm.
Hmm. Yeah. So you can't be excluded. It's just whether you want to sign up or not. So it's you ask to be included.
Correct.
Yeah.
Okay. Moving on. Abbas, just one for you. Now, given that there is this huge need of revenue in the current, given that there have been current tax cuts in the past 2 years, uh, should a DST be imposed on, like you said, the larger taxpayers for larger companies? For example, let's take the top 10, maybe the Facebooks and the Airbnbs. And if we do that, uh, you see, do we run the risk of them banning Sri Lanka or stopping services to Sri Lanka and thereby us being the sort of loser. Do you know if this has happened in any jurisdiction at the moment, and whether we should risk losing these facilities which are world class, which we are enjoying at the moment?
Yes. So I think, Suleiman, we need to, like I mentioned earlier, we need to really, instead of having a blanket answer to that, we need to really evaluate it based on some form of evaluation criteria which needs to be put into place. And like I said, maybe identify which digital services would actually, have a positive impact on the economy and which wouldn't. I think even if you really look at it in that sense, you could actually easily create some form of a criteria or a formula in place. Things like, simply put, what is the kind of foreign exchange that platform would be able to help the country generate, or what is the level of productivity improvements that platform would be able to help with. What is the kind of investment that platform would probably bring in or has brought in, maybe in aspects of options, in terms of, is there any alternative options within Sri Lanka that is already available. I think these kind of three criteria, I mean, for example, is there any HR utilization within Sri Lanka? Is there HR or people getting opportunities to earn earn some income from these platforms? So I think, is there any skills and development that is being done for our resources within Sri Lanka? I think there's so many criteria that probably needs to be put into a formula, and then it needs to be identified whether any of these large platforms, whether they actually meet this minimum point mark, and decide, okay, this platform is actually contributing towards the economy more than the losses in terms of revenue that it is, or foreign exchange that it is creating. And I think that decision is important. It's not easy. I wish it was easy, but it's not. But I think
I
that
think the
formula,
detailed analysis, like you say, I think all stakeholders might have to come together, the industry
yes.
plus the ministry, and get the
And I
right
think,
data.
and I think if those companies that actually meet those criteria and actually contribute positively, that positive contribution needs to be made into a whitelist and given the exemptions that are required. And anyone that is actually creating a detrimental effect by actually, creating, unwanted foreign exchange losses, or creating, unwanted, social impact, or whatever it is, in that sense, needs to definitely be looked at in some form of a taxation system or whatever it is. So I think that criteria needs to be put into place. I don't advise for a blanket kind of taxation for even whether it be just based on whether the company is large or not. No, I think that criteria needs to be selected.
So if there are any questions from the audience, please do put it into the Q&A box, and we'll take it, not the chat box, but the Q&A box, if there are any further questions. Just moving on to Sinyi. Sinyi, in the global context, not so much from Singapore, I think there has been significant revenue generated from DST. And the system is likely to change, from, like we discussed earlier, direct tax, indirect tax to a direct tax, and thereby potentially affecting this revenue pool that most jurisdictions, especially big market jurisdictions, have enjoyed. So although they've signed up to BEPS or this framework, do you think still there'll be pushback and several rounds of negotiations in terms of amending the framework to some extent as a result?
I think so far the OECD, whenever they have a milestone or a timeline, they have relatively kept to it. So I think they are working hard towards the October 2021 timeline. So we don't expect there to be deviations. So during this time, I think they are also working hard to bring on board the other members who have yet to sign up. So I think from that perspective, we do not expect there to be a lot of pushback, even though I think like you said, Sri Lanka's government is reviewing and then analyzing whether it makes sense for it to sign up. I think Ireland is also one of the countries that have yet to sign up, and they actually came out with a consultation paper requesting businesses to feedback on how they think BEPS 2.0 would impact them. And using those feedback, I think they will then take a stance of whether they want to sign up or not. I think the official message from Ireland is that they agree with the fundamental sort of principles. It's just that they do not agree with the minimum rate of 15%, because I think their current rate is at 12.5. So definitely they will be impacted. So I think they are taking a look and also getting inputs from the ground just to see what kind of impact would that be, and then formulate a response from there.
So lastly, Singhi, if you could just take us through a few high-level pros and cons that you think of adopting DST temporarily from a Sri Lankan perspective, and then adopting Pillar 1 and 2 from a developing country's point of view. And also whether you can only choose one pillar, that is Pillar 1, rather than accepting both, just to round it up. Some high-level pros and cons for it.
Sure. Yeah. From the maybe I'll start from the last question. So if you sign up for BEPS 2.0, you can. That means you sign up for Pillar 1. Pillar 2 is actually optional, so you can choose not to adopt Pillar 2. Although I think we're also thinking that it may, to many jurisdictions, especially those in the OECD or the developed countries, it may make sense for them to sign up, because if not, then they give up their taxing rights under the income inclusion rule. So we do expect a healthy sign up rate, I think, for Pillar 2. Then as regards the digital services taxes, currently the countries are, some countries have already introduced the digital services taxes, and some are in the process, so the proposed rules. So I'm sure these jurisdictions would have weighed the pros and cons, and then maybe they decided to go ahead with the digital services taxes because the pros outweigh the cons. So maybe from a collections perspective, from a level playing field perspective, it makes sense for them, and therefore they are still pushing out the digital services taxes. In some of the developing countries, our understanding, and based on the articles that have come out, is sometimes the digital services taxes are put in place just to encourage compliance, because it could be in a case where in the past it used to be there's really no framework. So there could be a lot of under payment or under reporting of such taxes. So with this digital service tax, it could be acting as a form of compliance, or forcing consumers to then take into consideration taxes that they need to pay if they were to purchase goods and services from overseas. So the variety of factors why countries introduce digital services taxes. And it could also be, especially now during COVID times, a lot of jurisdictions need the tax revenue. So it's a relatively easy legislation to put across and to collect the taxes. So that could be an avenue whilst waiting for global consensus, which has taken quite a while. So in the meantime, you still need your tax revenue to run the government agencies, and therefore that's could be a reason why they still roll out digital services taxes as well. So come Pillar 1, when it's implemented, then we will wait and see what kind of rules are going to be introduced such that your digital services taxes are to be withdrawn. And then how to withdraw it, what's the timeline, And those were the details that we will be eagerly awaiting on.
Thanks, Sini. Abbas, any final comments on the way forward? What would you advise from industry perspective that policymakers should probably take forward?
Sure. No, I think that what's important is that digital services is going to grow and grow. I mean, that's inevitable, and it's important that we address as an economy, as a country, we address the two key challenges that it's going to create. One being how do we make sure we manage our foreign exchange and ensure that we actually make sure that the foreign exchange doesn't get out of control in terms of loss of foreign exchange at least. And the second point would be, of course, to make sure that we create a fighting chance for some of the local players or the startup ecosystem that's actually getting into these spaces. And it's important that be it tax, be it any other method, but we need to put systems and structures in place to be able to manage these two. Whether taxes is the only answer to it, I'm not too sure. But I know for sure that we need to make sure that for the players who are getting into these spaces and competing against global large giants, they need the support of the government to make sure that they have incentive structures in place to support them, as well as they need to make sure that the government authorities or the different authorities, relevant authorities, ensure that anti-competitive practices are not being taking place and they are playing in a level playing field. I think if that element can be covered, I think a lot of the issues that the new startups and the players are having would be addressed. Right? Taxes, yes, of course, they could help in some sense, but I think more than that, if those two issues could be addressed by proactive, actioning of certain systems, I think that would probably sort out a lot of the issues, and that would create a very good level playing field and healthy level playing field with global competition for people to benchmark against. So I do hope that these things will be actioned soon, and we do see a lot more great innovations coming in, not just globally to Sri Lanka, but also in the global startup ecosystem in Sri Lanka itself. So that's it from me. Thanks.
Thanks, Abbas. So with that, I'd like to thank our speaker, Sinyi, for all the time spent and the excellent sort of expertise that you brought to our audience and to us, and sharing your knowledge with us. And Abbas also for joining in as our panelist. I would like to apologize once again for the absence of Dr. Kapila, who was to join us as a panelist. So thanking once again FITIS for this opportunity. I hand it over to Zulfa or Krishna.
Thank you, Suleiman. Thank you, everyone, for taking part in this session. A big thank you to Sinyi Wong, who connected from Singapore for this session. A big thank you to you, and of course to our moderator Suleiman for helping us put this together, and then of course Abbas to chip in this session. So on behalf of the Digital Services chapter at FITIS, I want to thank everyone who participated in this session. We will continue to address some of these seminars going forward, and we'll have new topics coming in. And for members, companies who are out here who wants to be part of an association such as this, please do get in touch with FITIS. A big thank you to everyone, and of course to all the sponsors that supported this event. Thank you, everyone. Thank you.
Thank you.